There are numerous ways to make money. Some are reliable, most are not. Many are risky, and a few offer less risk than what standard stock market methods would dictate. What I'm going to outline in this video is a process that enhances returns and lowers risk compared to just owning straight out stocks, be they blue chip stocks or other mid-cap stocks. Now, a lot of people turn off at the word options. As soon as they see it, they seem to just freak out and not understand what it's about and think it's a lot about risk. But having come this far in the series, I really encourage you to work through this one because writing covered calls is a tool that you really do need to know about as part of your wealth creating arsenal, that's for sure. Okay, so what is income from covered options, covered call options? It's basically a mechanism to generate extra income from owning stocks that you want to own anyway, and that's the key, the second part. This is something that you do on stocks that you're quite happy to own at that price regardless. It's a strategy that's more conservative than just owning the stock straight out. So I want to be really clear and upfront about that. There's nothing higher risk about this. It's actually a more conservative thing to do. There are one or two minor drawbacks that you need to understand, but I'll get to those. So it uses options, and options are often misunderstood, as I mentioned earlier, and I'd ask you just to clear your mind of whatever preconceptions that you have about options and just consider the possibilities. So basically, what is an option? A stock option is a privilege that's sold by one party to another that gives the buyer the right, but not the obligation, to buy or sell a stock at an agreed price in the future within a certain time period. So in the mechanism that I'm going to be describing here, we will be the party that is selling the option, and we're selling it to someone who wants to buy that option for perhaps insurance hedging purposes. Could be speculation, but often it's for hedging. So a lot of people ask me whenever I raise the topic of options that they've heard that options are very risky and they could lose a lot of money. And that is absolutely a true statement. But most people stand on the other side of the transaction. They buy options only, which is a really low reliability way to try and make money. And most people do end up losing money when they buy options. So that's actually a true statement. But we're talking about a completely different process. We're standing on the other side of this transaction. So what are covered calls? If we look at an example where a trader buys 100 or more shares of a stock or an ETF, and option contracts are struck in 100 share lots, and then they write or sell, means the same thing, an option contract that commits the trader to sell that stock or ETF for a preset price, and that preset price is called the strike price. So how do they work? Well, for multiples of 100 shares, as I said, we sell the right to someone else to purchase the stock from us at a predetermined strike at a point in the future. And it really works the same when you think about it as house or vehicle insurance. Now, when you take that out, you are the buyer. You're buying that insurance from an insurance company, and you're paying for protection that you may or may not ever make a claim on. So it's a peace of mind factor. And a lot of people do that own stocks, that don't want to sell them, but they're a bit nervous that the price of the option might go down. And so they just want to reserve the right to lock in a price that they could act on in the future. So in this case, we're the insurance company, and we're going to sell people that policy to fulfill their particular needs. So looking at it from the call buyer's perspective, the premium that they pay us to keep the stock available for them to purchase at the strike price if they choose. So that's a premium that they know that they could lose, but they're prepared to pay that, the same as we insure our car or our house. Let's look at it from the seller's point of view. So if we were to buy, let's say, 100 shares of company XYZ, and they were selling at $70, it's a company that we're very happy to own for the longer term, and we're very happy to own it at somewhere around $70. So what we do is we sell a call that's expiring in 30 days, and in this example, it has a strike price of $72. So we're granting someone the right to buy our shares at $72, and they pay us a premium of $1.9, which is the equivalent of 2.64% for 30 days. And these are fairly typical in the American market. Now, the outcomes that you get are really threefold in broad terms, but whichever outcome it is, you're better off irrespective compared to just owning the stock alone. So we'll look at three outcomes diagrammatically in just a moment, but those three outcomes are that the stock trades mildly below $72 at expiry. So it finishes above $70, but less than $72 in 30 days' time. The second scenario is that it trades above $72, which is the strike price that you had sold the call at. And the third alternative is that it trades below $68 at expiry. So let's look at those three. Now, the first scenario is that the price moves from where you first bought it at $70. It might move down a bit, it might move up a bit, it doesn't really matter. It's where it finishes at the end of the 30-day period. So in this case, we're finishing between the price that we bought the stock for and what the strike price of the call option was. So in that case, the price of the stock is below the strike, so therefore the option expires worthless. It has no value. So you get to keep the $1.90 per contract, or $190, because there's 100 shares per contract, and you've made a small profit on the stock, which could be anywhere between $0 and $2. So that, leaving out any gain that you have on the stock, that's a 2.64% gain for 30 days. Multiply that by 12, that's a pretty tidy annualized return. And then you're in the position just to do it again. You still own the stock, and you can just do it over and over again. Scenario 2, the option is exercised, so the stock price moves up, and at expiry it finishes above the strike price of $72. And so if you do nothing, then that stock will be called away from you. And what happens then, of course, is that you've made the $190 on the call option, so you get to keep that money regardless. And you've crystallized a $2 or $200 profit on the stock itself. All up, that's a gain of 5.57% in 30 days. That's a very attractive return. Now, the third scenario is that the share price falls from 70. Let's say it falls down below 68 at expiry. Now, if you just bought the stock, then you'd be $2 or more behind. But in this case, again, the option expires worthless because it's below the strike price. You've got a loss on the stock. We don't know what that is, but let's assume that it's at least $2. But we still have our gain on the call, so that $190 is ours to keep. And so we don't know what the balance is. It depends on how far down below $68 the stock is. But if it's around 68, then you're still around about break even. Whereas if you'd owned the stock only, you'd be $2 behind. And then, of course, irrespective of where the stock has gone to, we can then write another call for more premium for the following month. And so that gives us a mechanism to actually repair a stock that has gone down in price after we've bought it. So again, come back to, you buy a blue chip stock, it goes down in price, and all you can do is wait for it to come back up again. You have really no other course of action. But with using call options, you can actually progressively repair the damage. You don't have to wait for the price of the stock to actually rebound. So it's a very, very powerful tool to be using in conjunction with buying high quality stocks. So where do they work best? They work best where the stock price is not really trending strongly. It can move up and down, but as long as it's not trending strongly in one direction or the other. The American options market is far, far better than the Australian options market. There's just really no comparison between the premiums available and the depth of the market. What are the risks in writing covered calls? Well, if you aren't diligent about stock selection, if you choose stocks that are poor quality or stocks that may be high quality but they're overvalued, then writing covered calls can still be a process that loses you money. So it is contingent upon high quality stocks that are trading at or below fair value. Now, if the price of the underlying stock declines in the short term, which of course can do even if you tick all the other boxes, then your account value declines in the short term. However, it declines less than just owning the stock. So that's the first advantage. If the price of the stock rises strongly, then yes, your upside is capped. It's capped at $72 plus the premium. So that's a disadvantage of writing covered calls. But the advantage is that if the stock price doesn't move or if it falls a little bit, then you've made money. Whereas if you only owned the stock, then you wouldn't have made any money. So it's a trade-off. Other benefits of writing covered calls: you can write a succession of covered calls that can help you recoup losses on the stock value. And so therefore it can be a repair mechanism. It also provides you with time to assess what to do with the stock. So if you've written a covered call and the price of the stock goes down, and then you might write another covered call, it just gives you a few months to see if the stock is going to find some stability and then start to perhaps bounce back up again. So how would one go about getting started in writing covered calls? Well, you want to gain some knowledge on how options work in the real world of finance, and that's critical because a lot of material that's written is very simplistic. There are many nuances about the practicalities of writing options that unless you've got someone to guide you, just take you a long time of making mistakes to discover what they are. So really, really helpful if you can get some guidance in how it practically works. Descriptions in the text are, in my view, totally inadequate to prepare you for what the real dynamics of the market are. So you can accelerate your learning massively with some guidance. The next thing you need to do is to develop a watch list of suitable investment stocks and a target entry price that you think would be suitable for those stocks that you want to own. So there's my contact details. This is something that I do a lot of personally. I also do a little bit of private mentoring in the options area, and I also use options in the trading fund that where I manage other people's accounts as well. So until the next time, cheers.